After studying this module, we shall be able to understand the meaning of balance of payment, know the components of balance of payment, understand the BOP accounting, know about BOP disequilibrium, understand the different macroeconomic variables affecting the BOP, know the four BOP disequilibrium adjustment measures.
The term balance of payments is very often referred to in the news and is always a hot topic for political and economic discussions across the globe. The term balance of payments is very controversial and is used in various contexts, and in order to avoid ambiguity, it is essential to understand the meaning. According to V. Sharan, one of the authors, balance of payments is a macro level statement showing an inflow and outflow of foreign exchange. This means that it is a statement that records the flow of foreign exchange arising as a result of international economic transactions. These international economic transactions include export and import of goods and services, unilateral transfers, foreign direct investment, foreign portfolio investment, etc., which happen as transactions into the country and out of the country. A more comprehensive definition of balance of payments is provided by Scholl and Bruce. According to them, the balance of payments can be defined as the statistical record of a country's international transactions over a certain period of time, presented in the form of a double entry bookkeeping system. This definition shows that balance of payment statement has a time dimension, that is, it is prepared over a given period of time, normally which is 1 year. Since balance of payments is a statement showing the inflow and outflow of foreign currencies, in the case of one domestic currency with respect to the rest of the world, all receipts from foreigners are recorded as a credit bearing a positive sign, and these receipts accrue to a country in case of the export of goods and services. The receipts accrue in such a manner that the sale of goods and services enable the inflow of foreign exchange, because the payments in the international arena between countries is always made only in terms of foreign currency, and that too in terms of certain currency which are known as international currencies or are known as hard currencies. This could also happen through the sale of financial assets or real assets. Likewise, all payments to foreigners will be recorded in the balance of payments account as a debit bearing a negative sign. It indicates the outflow of foreign exchange for items of expenditure such as import of goods and services or for the purchase of foreign assets, whether financial or real. Likewise, the payments to foreigners also may include some items which are in the nature of unilateral transfers. Now, payments of foreign exchange also arise due to the import of goods and services.
The BOP statement covers and records all types of international economic transactions that a country engages in over a certain period of time. Based on the type of transactions, the BOP sub-accounts are as follows: the current account, the capital account, statistical errors and discrepancies, the official reserve account. Let us now try to know the first sub-account of the BOP, that is, the current account. The current account records all international economic transactions involving export and import of goods and services occurring within the current period. It has the following four subcategories: goods merchandise trade, service invisible trade, factor income, unilateral transfers. The first subcategory of current account is goods or merchandise trade. The export and import of goods is included in this subcategory of the current account. The exports of goods cause an inflow of foreign exchange into the country, while the imports of goods cause an outflow of foreign exchange from the country. The difference between the export and the import of goods is known as balance of trade (BOT). If export of goods is more than the import of goods, the BOT is in surplus. On the other hand, if import of goods exceed the export of goods, the BOT is in deficit. The next subcategory is services or invisible trade. This includes export and import of services. Services are intangible commodities. Since they do not have a physical substance, services trade is also known as invisible trade. Commonly, the international traded services are transportation, tourism, financial charges for banking and insurance, royalties for intellectual property rights, construction services, etc. The rendering or export of these services entities a country to receipt of the foreign exchange and is therefore recorded as a credit or the positive item. On the other hand, the utilization or import of these services creates a foreign exchange payment liability and hence recorded as debit or a negative item. We will now move on to the third subcategory, that is factored income. This includes income by the way of interest and dividend on investments made abroad in previous periods. Also, wages and salaries to the non-resident workers shall be included in this subcategory. And lastly, we have unilateral transfers. As the name suggests, this subcategory of current account includes one direction flows. Unlike exports and imports, unilateral transfers are unrequited or unreciprocated flow of funds. Hence, there is no offsetting flow against unilateral transfers. Flow of funds by the way of gifts, remittances, pension, foreign aid, official and private grants, and other similar transfers against which no services are rendered or goods provided are included in this subcategory. Receipt of such transfers causes an inflow of foreign exchange and is recorded as a credit or a positive item and vice versa. Moving on, let us now study about the capital account or the financial account. The capital account records all international economic transactions relating to investment in or withdrawal from financial assets and real estate. It reflects the flow of funds relating to international loans, investments, and banking funds. Investment in or purchase of financial and real estate abroad is recorded as a debit item in the capital account since it involves an outflow of capital. Likewise, Sale of financial assets and real estate to foreigners is recorded as a credit item in the capital account since it results in the receipt of foreign exchange. We shall now study about the components of capital account. The capital account includes FDI, FPI, and other investments. When a foreign investors acquire 10% or more of the voting rights of a domestic business with an intent to control it, such an investment is called foreign direct investment or FDI. Let us take an example to understand the concept of FDI. When the Japanese automobile manufacturer Honda built an assembly plant in Ohio, it made a foreign direct investment in Ohio. When a country receives FDI, capital flows into the country and hence it is recorded as a credit item in the capital account of the BOP statement. On the other hand, when a country makes FDI abroad, capital flight takes place. Hence, it is recorded as a debit item in the BOP. Portfolio investment. Portfolio investment includes the sale and purchase of foreign financial assets such as bonds, stock, money market instruments, financial derivatives, and the like, which does not cause a transfer of control. Purchase of Indian financial assets by the foreigners causes an inflow of foreign exchange and hence it should be recorded as a credit item in the BOP statement. Likewise, purchase of foreign financial assets by the Indian causes a capital flight and hence should be recorded as a debit item in the capital account. In the same way, withdrawal of investment in the foreign financial assets by the Indians causes an inflow of capital, and withdrawal of investment in Indian financial assets by the foreigners causes an outflow of capital. The capital account also includes other investments that takes into account transactions in trade credit, currency, bank deposits, etc. We shall now learn about the next component of the BOP statement, that is errors and omissions. It is also known as statistical discrepancy. It is considered while arriving at the overall balance. It arises due to the following reasons. Difficulty in data collection. Data for the BOP statement is collected from different sources and these sources differ in approach of the data compilation. Hence, statistics from the different sources vary, resulting in the statistical discrepancy in the BOP statement. Lead or lag transactions. Movement of the foreign exchange may lead or lag the transactions that they are financing. Example, if goods are shipped in March 2013 and the payment for them is received in April 2013, the sent shipment will be recorded in the financial year ending 31st March 2013. However, payment for it shall be recorded in the following financial year ending 31st March 2014. This difference leads to the statistical discrepancy in the BOP statement. Estimates. The BOP statement uses estimates to arrive at certain figures relating to travel, tourism, etc., for which exact amounts are difficult to ascertain. Estimates are based on samples. If the sample chosen is defective, statistical discrepancy is bound to arise. A further reason for statistical discrepancy in the BOP statement are unrecorded illegal transactions. Once statistical discrepancy is identified, the overall balance can be arrived at. The balancing between all credits and debits in the current account, capital account, and the statistical discrepancies represent the overall balance. If the overall balance is in surplus, the surplus amount is used to repay borrowings from the IMF and the balance, if any, is carried to the official reserve account. If the overall balance is in deficit, the monetary authorities of the country arrange for the capital flows via drawings from the IMF or official borrowings or by bringing down the foreign exchange reserves to make good the deficit. Based on the flows that we have covered so far, capital account flows can be of two types: accommodating capital flows and autonomous capital flows. Accommodating capital flows, or above the line capital flows, is the inflow of capital meant to cover the overall BOP deficit. The objective of such flows is to bring the BOP statement into equilibrium. It usually includes drawings from IMF. Autonomous capital flows, or the below the line capital flows, is the inflow of the capital which occurs regardless of any deficit in the BOP. Example: foreigners repaying the loan, FDI inflows in the country, etc. The last component of the BOP statement is the official reserves account. The official reserves account records monetary gold, SDR allocations to a country by IMF, and foreign currency assets held by monetary authorities of a country. If the overall BOP is in the surplus gets added to the official reserve account. If the overall BOP is in deficit, the official reserves account gets reduced by the deficit amount if accommodating capital flows are unavailable.
Now, let us move on to the discussion on the balance of payments accounting system. International economic transactions are recorded in the balance of payments in the form of a double entry bookkeeping. Every credit has a corresponding and matching debit entry and the vice versa. This means that disequilibrium in the balance of payments does not occur. However, this is only from an accounting viewpoint because the credits are matched with corresponding debits. Of course, if the entries are currently recorded. Now, let us take up an example. Suppose an export house in India exports garments worth rupees 10 million to the US, and the United States pays for it from its rupee bank account kept with India. Then the receipts of rupees 10 million by USA will be recorded as a credit or a positive item in the current account, and its corresponding debit or negative entry will be in the capital account, showing a reduction in India's bank's liabilities. It should be noted that though balance of payments is based on the double entry bookkeeping system of accounting, however, individual transactions, that is, the current and capital account entries, are recorded independently of one another. Hence, due to mistakes and errors and such things as statistical discrepancies, the debit of the balance of payments may not match entirely with the credit, and hence we may have some kind of difference between the overall balance. Hence, the balance of payments account in a statistical sense may not be always in a balance. Now, we shall develop an understanding of the concept of disequilibrium in balance of payments. Often, two statements are made, namely, balance of payments is always in a balance and balance of payments disequilibrium always exists. This statement is the first statement is a statistical explanation of the equilibrium in balance of payments. However, there are two notions of equilibrium. The first notion is an accounting notion. Here it is said that balance of payments is always in a balance. It must first be understood that unlike an ordinary system of accounting, the balance of payments account is a peculiar account. It is a single account in which there are two accounts, the current account as well as the capital account. On the whole, it is treated as a single account. Now, this is not the case when we look at the accounting system of firms. The receipts and payments in the current account are revenue items, that is of income and expenditure. Therefore, any surplus of expenditure, which is expenditure on imports, over the income from exports would result in a revenue deficit. This deficit is known as the current account deficit. In an accounting sense, the balance of payments account is said to be always in a balance because it is a single account. The deficit on the current account has to necessarily be matched with a surplus on the capital account. In this sense, the balance of payments account is different from, or the process of accounting in balance of payments is different from the process of accounting in financial accounting. Hence, balance of payments being a single account is recorded in such a way that on the whole it remains in a state of balance. This does not preclude the possibility of a deficit or surplus arising in any one of the two constituents of the balance of payments account, namely the current account or the capital account. One part of the account compensates the deficit or surplus in the other part of the balance of payments account. Therefore, this possibility can be explored and understood in a different sense. In an economic sense, therefore, the balance of payments account in most cases is found in a disequilibrium, which actually means that the revenue items of expenditure and income would only rarely match. So, in this sense, in an economic sense, disequilibrium in balance of payments cannot be dubbed under the notion of double entry system. Therefore, if there is any difference between the receipts and payments, this leads to a surplus or deficit on the current account. Now, ordinarily, when we say that a disequilibrium exists in balance of payments, we are talking about disequilibrium in the current account. Why is it so? Because if there is a surplus on the current account, it is truly not a problem. So, only when we feel that there is a problem in the balance of payments, and that is how we would define disequilibrium, that we treat it as a disequilibrium and that we treat it as a problem. So, therefore, disequilibrium normally exists in the current account, and this is an economic notion of disequilibrium in balance of payments. Now, what are the different types of disequilibrium? There are three main types of disequilibrium which are caused by different conditions. These are cyclical disequilibrium. This arises due to trade cycles or business cycles, which often happen because of differing cycles between the trading partners. Under such circumstances, there would be periods when exports boom and other periods when imports are higher. The other type of disequilibrium is fundamental disequilibrium. This refers to a state of deficit in the balance of payments caused by the fundamentals of an economy, the weakness in the fundamentals of an economy. This includes low growth of the economy, high cost price structure, low efficiency. All of these fundamental factors result in a long term phenomenon which can be corrected only with structural changes in the economy. So, therefore, we have cyclical disequilibrium, fundamental disequilibrium, and then there is another type of disequilibrium called structural disequilibrium. This is caused by changes in taste, culture, technology, and so on. For instance, developed economies may discover synthetic substitutes for primary exports from developing countries. Typically, in recent years, jute, for instance, has found lots of synthetic substitutes. This results in a permanent fall in the export potential of developing economies who are essentially primary exporters. Therefore, in the long run, there would be a tendency towards deficit in balance of payments.
Let us now try to understand the BOP disequilibrium. BOP is said to be in disequilibrium if there exists any surplus or deficit in it. Balance of payment equilibrium occurs when every surplus or deficit in it is eliminated. Practically, BOP is rarely in such a situation. It is either in surplus or in the deficit. Several key macroeconomic variables interact with the BOP and cause disequilibrium and or correct it. These variables are as follows. First, GDP or national output and national spending. If a country's national income exceeds its national spending, the excess of national income over national spending will be invested abroad, giving rise to the capital outflows. This shall cause a capital account deficit and vice versa. Second, money supply. An increase in money supply, if not accompanied with a proportional increase in output, causes an increase in the price level or inflation. People substitute the more expensive domestic goods with the cheaper foreign goods by importing them. This causes a current account deficit. Moreover, with inflation, exports turn uncompetitive in the global marketplace. This causes the export bill to fall, further widening the current account deficit. The reverse happens when the money supply in the economy reduces. Third is interest rate. As the domestic interest rate increases, capital investment in the country becomes more attractive as they would now yield greater returns than in the rest of the world. This causes capital inflows into the country, which leads to the capital account surplus, and if interest rate reduces, the reverse holds true. Lastly, we have the exchange rate. Taking the example of fixed exchange rate system, in the fixed exchange rate regime, the government intervenes to correct it. If the BOP is in deficit, this means that there is an excess supply of the domestic currency in the international market. The government, in such a situation, will buy the domestic currency from the international market and brings back the exchange rate at the previous level. This shall make imports expensive and exports competitive, causing the current account deficit to reduce to near zero level. If BOP is in surplus, reverse will take place.
In a fixed exchange rate regime, the onus of maintaining the exchange rate lies on the government. If the balance of payments is in a state of disequilibrium, then the government has to intervene in the foreign exchange market. If the balance of payments is in a state of disequilibrium, it means that the domestic currency is overvalued. The domestic goods do not command the same demand in the international market. Thus, exports are low and imports are high. this results in a disequilibrium in the balance of payments. Under such circumstances, the government would devalue the domestic currency, as we know that under the fixed exchange rate system, the monetary authority which is in charge of the foreign exchange reserves uh, would make an announcement by which the currency gets devalued. Under such circumstances, imports become more expensive and domestic exports become less expensive. This causes a reduction in the current account deficit. Under the flexible exchange rate regime, the balance of payments disequilibrium theoretically adjusts to the exchange rate in the direction that is required. For example, if a country has a deficit in the balance of payments, this means that there is an excess demand for foreign currency since imports are high. At the same time, the supply of foreign currency is low due to low exports. This leads to an appreciation in the foreign currency and automatically a depreciation of the domestic currency. The domestic currency faces depreciation by virtue of the domestic invisible market forces in the foreign exchange market. Once domestic currency depreciates, it makes imports dearer and exports more attractive, and this corrects the balance of payments disequilibrium. Under the managed float regime, the government plays an indirect role such as altering the relative interest rates in maintaining the exchange rate with a view to correcting the balance of payments disequilibrium. BOP disequilibrium in the current account is a problem because it has implications for the exchange rate, and very often it is not possible to correct such a balance of payments disequilibrium, especially if it is a fundamental disequilibrium which is long run in nature. A surplus of balance of payments is not a difficult situation because a surplus can be used to repay debt obligations or to be invested abroad. But if the balance of trade faces a large deficit, then it as such cannot be covered by invisible trade surplus, and the current account would be facing a deficit in the overall sense. For balancing this deficit, we need to have accommodating capital flows. Such accommodating capital inflows are not smooth, and hence correcting the current account deficit under such circumstances becomes a difficult problem. If this deficit persists for a long time, the country's official reserves account would get eroded, and eventually the country may find itself in a debt trap. It is for this reason that balance of payment disequilibrium correction mechanisms aim at correcting the imbalance in the current account.
After knowing about BOP disequilibrium and the various macroeconomic variables affecting and being affected by the BOP, it is the time now to discuss in brief the various approaches to adjust a BOP disequilibrium. There are four main approaches that help to adjust the BOP disequilibrium. These are the classical view, the elasticity approach, the Keynesian approach, and the modern approach. We shall discuss these approaches in detail. The classical approach. The classical economists were of the view that the BOP disequilibrium was self adjusting. For example, as Money supply in the economy increases, prices rise, exports turn uncompetitive, and imports become cheaper. This causes export to drop and imports to rise. With the two events happening, a BOP deficit increases. This, in order to finance the imports, precious metals leave the country. This reduces the money supply in the economy, which lowers the price level. Lower prices make export rise and import fall, thus correcting the BOP disequilibrium. The elasticity approach, also known as Marshall-Lerner approach. The elasticity approach added the concept of elasticity of demand of exports and imports in the process of altering the fixed exchange rate to correct the BOP disequilibrium. It is based on the partial equilibrium analysis where we observe the effect of exchange rate on the export and import ceteris paribus. Also, it assumes the elasticity of supply of output as infinite such that the price of exports does not rise as the export demand rises, and also that the price of imports does not fall with the decrease in demand for imports. The approach also ignores the monetary effect of changes in exchange rate. The approach states the currency devaluation would correct BOP disequilibrium only if the elasticity of demand for the exports and imports is greater than 1. The Keynesian approach. The Keynesian approach takes into the consideration the income effect that was not considered in the earlier approaches. According to this view, balance of trade is the difference between what an economy produces and what it consumes domestically or absorbs. If total output in an economy is greater than its absorption or domestic consumption, there is surplus in the balance of trade. On the other hand, if absorption is greater than the total output, the balance of trade is in deficit. Hence, to bring BOT into the equilibrium, the government has to increase output or income. Rise in income without a proportional increase in absorption will correct the BOT deficit. This is known as expenditure switching policy. If the economy is operating at the full employment level, the BOT deficit can be corrected by reducing absorption without a proportional fall in output. This is known as the expenditure reducing policy. If the economy is not operating at the full employment level, the government can adjust the trade by balancing the increasing output and or the absorption.
The fourth and the last approach to adjusting the balance of payments disequilibrium is the monetary approach. The monetary approach to balance of payments disequilibrium seeks to equilibrate balance of payments by bringing a parity between demand and supply for money. The main thesis of the monetary approach is that a country's balance of payments is essentially a monetary phenomenon and that any observed disequilibrium in the balance of payments can be eliminated through a appropriate manipulation in the monetary variables, especially domestic credit under the fixed exchange rate system, the absence of sterilization by the monetary authorities, and a stable demand for money function. The approach that emphasizes the monetary aspect of balance of payments, this approach that is emphasizes the monetary aspect of balance of payments and looks beyond the merchandise trade and incorporates the importance of the role of financial assets in managing the balance of payments. The monetary approach takes the money supply in an economy as being endogenous, and it is the changes in the international reserve position as shown in the balance of payments that provide valuable inputs to the central bank to manipulate its monetary liabilities.
Let us now recapitulate what we have studied in this module. In this module, we have learnt about the BOP and its components, namely the current account, the capital account, the statistical errors and discrepancies, and the official reserves account. We have also discussed the BOP disequilibrium, the macroeconomic variables causing disequilibrium, and the various approaches for its correction. These are the classical view, the elasticity approach, the Keynesian approach, and the modern approach.
We can conclude this model by saying that balance of payments is a statement showing the inflows and outflows of foreign currency in a country over a certain period of time, presented in the form of a single account. This single account consists of two accounts, the current account and the capital account, and the process of maintaining the balance of payments account is in the form of the double entry bookkeeping process. All receipts from foreigners are recorded as a credit or a positive item. Likewise, all payments to foreigners are recorded as a debit or they bear a negative sign. Balance of payment sub-accounts are as follows: the current account, the capital account, statistical errors and discrepancies, and the official reserves account. The current account records all international economic transactions involving export and import of goods and services occurring within the current period. The current account has again four subcategories: uh, goods, that is merchandise trade; services or invisible trade; factor incomes; and unilateral transfers. The capital account has all those international financial transactions entered in it which relate to investment or to the withdrawal of any financial assets as well as real estate. The capital account includes foreign direct investment, foreign portfolio investment, and other such investments. There is an entry which relates to statistical discrepancies, and this arises due to difficulties in data collection or lead and lags in transactions and differences in definitions, estimation, and unrecorded and as well as illegal transactions. The official reserves account records monetary gold, SDR allocation, and foreign currency assets held by the monetary authority. Balance of payments disequilibrium occurs in the economic sense when there is a deficit on the current account. There are different types of disequilibrium: fundamental disequilibrium, structural disequilibrium, and cyclical disequilibrium. Several key macroeconomic variables interact with the balance of payments and cause disequilibrium or also help in correcting the disequilibrium. These variables are generally the GDP, money supply, interest rate, exchange rate, and so on. Balance of payments disequilibrium has implications for the foreign exchange rate as well. When there is a deficit, it leads to a depreciation, and when there is a surplus, it leads to appreciation of the domestic currency with respect to foreign currencies. There are four main approaches for adjusting the disequilibrium in balance of payments. These are the classical approach, the elasticity approach, the Keynesian approach, and the modern approach.